Hello and welcome to CNBC-TV18's Mumbai newsroom. I'm Sumaira Abdi and you're watching MF Corner. Joining in today, we have Nasser Salim, Managing Partner at Flexi Capital. And today, Nasser will be talking about some of the key ratios which are important for mutual fund investors to know about, at least know about, if not track all of them, because, there are quite a few in the universe. So pick and choose the few that matter to you as an investor. So Nasser is going to make that short list for us and also explain these ratios. Nasser, good afternoon. Thanks very much for joining in. We'll start with the most common or should I say the most useful for retail investors, which is standard deviation. Would you agree?
Yes. Good afternoon, Sumaira. Wonderful to be back on MF Corner, and thank you for inviting Flexi Capital. As you rightly said, the list of metrics or the formulas, the ratios are very large, but it's best to kind of shortlist at least some of the most important ones. And what better than standard deviation? I think, before I get into the ratios quickly, Sumaira, I'd like to just highlight 2 or 3 key points to your viewers. Number one, these ratios, these metrics cannot be used in isolation, so you must consult an expert distributor or an advisor in the mutual fund space. Number 2, they have to be used not in isolation, as I said. They have to be used collectively to understand the importance of risk-adjusted returns, and therefore, it's important for me to kind of highlight these 2 things. Cutting to the chase and getting to what you asked on standard deviation. This is a very important statistical measure, Sumaira, and what it does is that it basically measures how much a portfolio's returns deviates from its average, as the name in itself suggests. Typically, it reveals the volatility, which is how much volatile a particular fund or even a particular stock is, for that matter. It shows how far a mutual fund's performance deviates from its expected returns, and therefore, to use standard deviation, Sumaira, as a performance ratio, one needs to compare 2 funds belonging to the same category. So, for example, you can't compare using standard deviation, say, for example, between a large cap or a small cap, because it will give up very different results. So very importantly, in other words, you cannot determine if the standard deviation of a fund is high or low without comparing it to the other funds in the same category. Having said that, what we always have seen and witnessed is that a high standard deviation indicates a wider range of returns, whereas a lower value indicates a narrow range of return. So somebody who's willing to take lower risk per unit of their money invested in funds, in mutual funds, PMS, AIFs, should look at this number very importantly, because it will tell you and suggest to you a low standard deviation means lower risk on your return that is being generated.
Okay, fair enough. But Nasser, how would this differ from, say, something like a Sharpe ratio, right, which is also used to sort of figure out how much risk is there in that scheme?
Okay, great again. See, a Sharpe ratio, Sumaira, is a performance metric which is slightly different from the 2. But again, great question, because you need to use them both together to understand the risk involved in a particular fund. So coming to Sharpe ratio, let's first understand what Sharpe ratio means and what it basically tries to imply when you're evaluating a performance through Sharpe ratio. Sharpe ratio is basically, Sumaira, a performance metric that helps in estimating a fund's risk-adjusted return. Now, what is RAR? Risk-adjusted returns are returns that a fund generates over and above the risk-free rate of return. Now, what is the risk-free rate of return? That's basically what you get through sovereign securities or sovereign papers, where the risk of default is negligibly, actually it's 0, practically. And therefore, the Sharpe ratio takes into account an investment's inherent risk, Sumaira, which is standard deviation, which we just spoke about. And as a result, the Sharpe ratio aids in determining a fund's return generating capacity for each unit of risk it absorbs. And therefore, when you combine these 2, which is Sharpe ratio, is nothing but the mutual fund returns minus risk-free rate, which is the government security or risk-free return that you get from investing in a government paper, divided by the standard deviation. Now, this obviously is again a quantitative metric that gives you a snapshot of the fund's performance. Again, you can use two funds to compare. It obviously helps you to understand if it is able to generate returns than higher than the risk-free rate. And the higher the ratio, the better investment return in comparison to the risk. So a higher Sharpe ratio indicates a better risk-adjusted return, Sumera. And that's how you use both the metrics.
Okay, understood. The next one is new to me as well, Nasser. So thanks for introducing this. What do you mean by information ratio?
Okay, again, so a lot of people have asked this, Sumera. They thought that this is something which is proprietary to Flexi Capital. It's not. I must be honest with you. It's a very interesting ratio again, which talks about again risk-adjusted returns of a mutual fund portfolio, and this is relative to a benchmark. Now, again, when we were starting out, I said it's very important when analyzing these funds. You have a group of funds or three group of funds or five set of funds that you're comparing returns, and you're looking at various metrics. But a very important factor again between all of this, Sumera, is a benchmark. Now again, you can't compare a large cap fund, say for example, with a small cap index. I mean, it has to be compared with the Nifty 50 or with the BSE 200, depending on which category of large cap you're investing in. And therefore, the relevance of the risk, the IR, which is the information ratio, basically compares the risk-adjusted returns of a fund portfolio to its benchmark. Now, the purpose of this ratio is to show excess returns, Sumera, relative to the benchmark, as well as the consistency. So I'll again repeat this. Consistency is also very important. So it basically compares relative outperformance to the benchmark with consistency, with which excess returns are generated. The information ratio is used to evaluate basically a manager, the fund manager, the asset manager's trustworthiness, Sumera, risk management expertise, ability to outperform the benchmark. And therefore, using the information ratio, we can determine how successful a fund investment and allocation strategy is. Typically, what we track is something called the tracking error, which indicates how consistently the fund is able to generate excess returns over the benchmark. Benchmark here is very, very important. So, my last thing on this is a low tracking error shows that the portfolio outperforms the benchmark on a consistent basis. The fund's performance is highly volatile if the tracking error is high. And that's why the two are very, very important.
Okay, fair enough, and very, very interesting also. The other is this capture ratios, right? Both upside and downside capture ratios. What do they mean, and how can a retail investor use them meaningfully?
Okay, so again, the name in itself tells us what it basically is trying to imply, and it basically emanates from the fact that upside and downside capture ratios guide an investor, Sumera, on whether a fund has outperformed, gained more or less than a broad benchmark index in this case during two phases. So upside will obviously become during the phase of market upside, which is in case of a strong bull run, or downside is basically in case of bearish market conditions or weak market conditions. These ratios essentially guide an investor on how much the fund has risen when the markets rally or how much they have fallen during corrections. That's broadly the definition of upside and downside. Now, basically wanting to get into the specifics of each, if you may allow me, Sumera, which is basically upside capture ratios and downside capture ratios. In specifically talking about upside capture ratio, I just explained to you, the ratio is used to analyze the performance of a fund manager during bullish runs. That is when the benchmark has risen exceptionally well or has gone up. A fund, and by the way, it's also denominated in percentage terms. The ratio of upside is in percentage terms. And basically what it means is, broadly, is that a fund having upside capture ratio, for example, of say 150, shows that it's gained 50% more than its benchmark in bull runs. So assuming the benchmark index has gone up by 10% and the fund has delivered a 150 upside capture, which we capture through the formula, it will suggest to you that the fund has delivered a higher upside capture ratio. That's what it basically signifies. The ratio basically is the ability of the fund to beat the benchmark at the time of bull runs, as I said to you. So you get an idea of how much more returns the fund has generated as compared to the benchmark as expressed in percentages broadly. And the formula is very, very simple. It's fund returns, Sumera, during bull runs divided by benchmark returns multiplied by 100. And therefore, an upside ratio of over 100 means that a given fund has beaten the benchmark during a period of positive returns. That's what upside capture ratio signifies. On the downside capture ratio, Sumera, it's exactly the opposite of this. This is used to analyze how a fund manager has performed during bearish times or bear runs, right, broadly, when the benchmark has fallen. This ratio, again, one can get an idea of how much lesser returns the fund or the scheme has lost as compared to the benchmark at the time of bearish returns. A downside ratio, this is very important because it's exactly opposite of what I just told you in upside. Here, a downside ratio of less than 100, Sumera, shows that a given fund has lost less than its benchmark because you're looking at opposite directions here. So therefore, a downside ratio of less than 100 shows that a given fund has lost less than its benchmark during the phase of dull returns or bear returns. So that's broadly between downside and upside capture ratios.
Okay, and that is a true measure really of an active fund manager, right? That in an upward momentum market, you should perform better than the benchmark, and in down phases, you should lose less. Nasser, stay on. We're going to take a very quick break. There's more that we want to talk about on the other side, so do stay tuned in. We'll be right back.
LIC आत्मनिर्भर भारत की गौरवशाली संस्था मना रही है आज अपना स्थापना दिवस। गत 66 वर्षों से मिल रहे आपके प्यार और विश्वास के लिए हम आपका हृदय से करते हैं धन्यवाद। सुरक्षा और वचनबद्धता का ये सफर हमेशा रहेगा बरकरार। LIC हर पल आपके साथ।
पावर সাপ্লাইতে মেজর ফল্ট আছে।
বাইরে সিকিউরিটি আর নিজের বাড়িতে এসব।
दादा बचा लिया आपने।
बेफिक्र कोलकाता जाओ, इंटरव्यू अच्छा ही होगा।
हर बंद राह ओपन हो सकती है, लगता है सिर्फ दिल। एक्सिस बैंक, दिल से ओपन।
Hi, welcome back to MF Corner. Nasser Salim, managing partner at Flexi Capital, is with us, and he's been talking about some of the ratios which are important for mutual fund investors, especially in terms of measuring returns or risk. Now, we've spoken about a few ratios. The next one, and Nasser, this is one which a lot of people get confused about, is what is alpha?
Yeah. So again, Sumera, thanks. So alpha is a risk-adjusted return metric again. And why we keep talking about this word risk-adjusted return is very important for viewers to understand this, Sumera, is because, for every money that you invest in a fund, there is a risk of unit that you are taking in order to generate those returns. And therefore, it's a very, very important term which is used for all the metrics that we are talking about. Alpha is nothing but basically a measure that compares a fund's performance to its benchmark. So a fund with alpha of 0, for example, has delivered the same returns as the benchmark. A negative alpha indicates that the fund has underperformed its benchmark. And alpha is basically nothing but a mutual fund return minus the risk-free return we spoke about at the beginning of the show, multiplied by and then subtracting the benchmark return over the risk-free return into beta. That's basically what alpha is. I don't want to get into the formula so much because I can't explain it to you verbally. It has to be shown pictorically, but alpha greater than 1 indicates the fund's outperformance. That is basically what we need to track when we're looking at alpha. So a fund with alpha of 0 means that it has delivered the same. A negative means it's underperformed the benchmark. and alpha greater than 1 indicates that the fund has outperformed. That's broadly what alpha means.
Okay. And the other one that always follows alpha is beta.
Yes. So beta is again basically what we track, something called sensitivity, which measures the sensitivity for mutual fund towards dynamic market movements. Now, considering where we are today in terms of the market environment, Sumera, markets have been seesaw. We've seen intraday movements, and even today we saw the markets, moving sharply one way or the other. I think this is a very, very important metric that we need to kind of understand. And why I'm saying this is because it tracks sensitivity of a particular fund. It's a metric that measures how volatile a fund portfolio is in comparison to the overall market, right? Looking at a mutual fund, for example, or a portfolio management, a PMS, or an EIF, one can get a sense of how the fund responds to market fluctuations, which is what we are currently going through, higher than as compared to what we were in the last few quarters. A beta of a market or benchmark is always 1. So the market benchmark is always 1. A beta greater than 1 suggests a high level of volatility. So when you're looking at for example, if you're interacting with your mutual fund distributors, your RIAs, your advisors, it's a good discussion to have with them, to ask them, look, today we're recommending this or soliciting these funds. What is the beta of this? It's a great discussion to have had. And if a beta of less than 1 suggests lesser volatility, Sumera, when compared to the benchmark, a beta of greater than 1 suggests a volatile fund. So ideally, what we need to track is you get good returns, but with a lower beta. Ideally, that's the best scenario to be in when you're looking at this particular metric.
Okay. And what about manager tenure? I assume this relates to how long a fund manager has been with the AMC?
Absolutely. So, again, this is one of, if I can say so, the qualitative metric that we use, Sumera. So see, fund management is a very important wheel in this entire fund management and, the concept of generating wealth and returns and, fund management and so on and so forth. And therefore, a fund manager, the number of years the current manager has spent in the portfolio managing that fund is very, very critical. Now, here's what we've seen in my last 18 years of my career. I've never come across where a fund manager has not been named. But in the evidence of him not being named, you may want to ask certain questions. Many a times, investors don't ask this question. They can do some basic research on the fund manager, his pedigree, his style of investing, perhaps even his qualification, his experience. All of these matter, and even his ethics. I mean, we've had fund managers. I wouldn't want to name any, but it's important to just know. And therefore, fund manager is basically a manager tenure is basically nothing but how long he's spent time with the fund management team as a fund manager. And if one buys a fund, you're obviously buying it for the long term in equity, for long term performance. So therefore, you surely want to know how long has the fund manager been associated with that particular fund. So it's it kind of complements each other very, very well, and therefore it should be questioned.
Okay, and the last one sounds, what can I say? I think closest to an investor's heart, which is gain to pain ratio. What exactly is this?
Sumera, I must tell you, both my co-founders, Sanket Kapoor and Ankit Saigal, were fighting it out and saying, you must mention this on the show. So I said, "Acha, dekhte hain." So you know what? This is a very interesting. It's a very interesting metric, and what it says is that it's one of the best measures of return and risk profile, Sumera, of any fund. I don't hear many people talking about it, and it is calculated basically by measuring the expected gain or return of an investment and dividing it by the potential pain or drawdown. Now, simply, what I want to say is that, there is there are times when markets go up, and then there are months when markets, come down. Now, how do we track this with respect to how much of the pain is being generated to get that gain? I mean, that's basically put. And what it says is, it basically says total excess returns of the fund, which is over its benchmark, in a period divided by absolute value of negative returns. So what it factors in, Sumera, what we have to understand is everyone is talking about positive returns and relative outperformance to benchmark, comparison to two broad funds, but no one talks about negative returns. So therefore, it's very important to kind of understand what is the negative return capture, and is there any metric that is also ensuring that you've taken negative returns in that period of performance to kind of understand the returns and what is the gain that you're getting on the account of that pain. And simply put, a higher ratio is better, a lower gain to pain ratio is obviously not recommended. There is a small case study, because this is I just wanted to showcase that to your viewers and to you and talk about that. Basically, is that if there are two funds, Sumera, Fund A, absolutely, I was looking for this on the screen. Thank you very much. So if you look at these two funds, one is Fund A, one is Fund B, and Fund A, for example, has given a return of monthly return of 5, 8, 5, and -6 and 8%. So total return in this fund, Sumera, is at clear 20%. Now, the total pain months, which it went down to, was -6%, as you can see on the slide. Now, if you divide by the simple formula, it's the gain, which is the total return over its benchmark, divided by the loss for that particular month, which is 6%. The gain to pain for Fund A is 3.33 times. Similarly, if I were to compare this to Fund B, again, they have generated a 2%, a -2% in the successive month, 15% up in the third month, -8%, and then 13%. So the total return that Fund B has generated is also 20%, Sumera. So you have both the common barometers, 20% in Fund A, 20% in Fund B. However, the total of pain months is -2% in one month and -8% in the second month, or the last, the fourth month. If you combine these two, it's a -10%. You divide the same formula, you get 2 times. So obviously, between the two, Fund A and Fund B, what it's showing is that higher the gain to pain ratio, the better the fund manager, as returns are coming with lower pain or drawdowns or negative returns. That's broadly what the gain to pain ratio estimates and calculates for investors.
Okay. Nasser, the other thing is that, while ratios like standard deviation or Sharpe ratio are easily accessible to all investors on various websites, etc., some of the others, like the information ratio you mentioned, or this gain to pain ratio, where can this be accessed?
So again, great question. All of it can be accessed on multiple platforms. There are dedicated research engines that are available. You can speak with your distributors, advisors. Also, most of this information you can cull out from your key information memorandum and SID. It talks about various ratios, and if not, you can also pull them out from, as I said, there are various platform providers who give these ratios on a monthly and a quarterly basis. So getting this information is not very difficult, Sumera, and I can tell you, as your expert, the people you consult with, or your viewers consult with for investing, they will have access to all this information through the research engines that are available.
All right, Nasser, thanks very much for joining in and for explaining these ratios and how they can be used by retail investors. With that, we'll wind up on MF Corner for today. Thank you very much for watching, and do stay tuned in. The team of Closing Bell joins you next.